Hi everyone, Simon Barwick here from Bentleys Wealth Victoria. Hope you're well. Presenting our April portfolio and market update. Firstly, this is general advice, so if you do have any questions, please speak to your advisor. Well, once again, it's been a volatile month, as it has been for pretty much this calendar year to date. Really, oil prices and stagflation have driven or complicated global central bank policies and have driven volatility. Equity markets are increasingly driven by energy security, with clear winners and losers, but not earnings. Geopolitical tensions are now the key short-term driver of markets, and technology valuations have reset on their earlier falls, improving sort of long-term risk-reward trade-offs. Gold has weakened in the short term, but remains a strategic way to diversify portfolios. If we look at our global economic outlook and scenarios, these really remain unchanged from last month. We still believe there's a 50% chance where we'll have below trend growth. Growth stabilization, we think, will be about 35% chance, and a deep recession risk is about a 15% chance. If we look at markets and market returns over the March month, Australian equities fell 7.3%, and that was the All Ordinaries. The RBA increased cash rates to 4.1%. Energy stocks were strongly positive. Gold stocks fell, and technology and property were hurt, but have now since recovered. And finally, small caps underperformed significantly due to margin pressure. If we look at global equities, the S&P 500 was down about 5% in US dollars terms. The Nasdaq fell over 7%, and US small caps also fell by 7%. Japan was down 12%, its worst return since the GFC. Europe also declined sharply, and emerging markets were sold heavily, so it was pretty ugly across the board. Commodities, oil rose around 54%, not surprising in an oil crisis. Gold, as mentioned, fell around 12% due to forced selling, and iron ore rose 8.8%. If we look at our asset class views, we believe, from a government bond perspective, we're underweight just really on a duration perspective. Our credit, we prefer investment grade over high yield at the moment. Equities, we prefer global over Australian. Small and mid caps, we're going to maintain our exposure. Private equity is still attractive from a diversification point of view, but you've really got to look at any AI and infrastructure exposure, and gold is constructive on the medium to long term. And emerging market investment really needs to be supported by valuation. Something else to note really is regarding where we sit from a US election cycle. Markets historically struggle as we come to or around elections. We have the midterms coming up, so we will probably see some more volatility in the short term. Historically, though, US equities do rally after the outcome is known. So it's really, we'll see what happens, but political pressure increases the likelihood of probably a Middle East de-escalation by mid-2026. Now, we have touched on stagflation previously, and this is one of the subjects I studied when I was at uni as one of the introductory economic subjects. So I just wanted to cover that because we are seeing that in the news a little bit now. So really what that is a situation where you've got high inflation combined with weak or slowing growth. Now, this is particularly difficult for households and investors at the same time, and it is a challenge for central banks. So this really happened the last time in the 1970s, where we also had a supply-driven recession. Now, I know we're not in a recession at the moment, but we are in an oil crisis, which was predicated that recession of the 1970s. Now, over the last 4 recessions, they have been demand-driven. So the typical way that the central banks deal with a recession in these times is by reducing interest rates. And reducing interest rates then will increase affordability and then stimulate demand to then hopefully trade out of that recession. However, if you've got high inflation already and any sort of cuts to interest rates will worsen inflation. So it does sort of tie the hands behind many central banks. Now, they do have other policy levers, and they did learn from the 1970s, so it will be interesting to see how they manage this going forward. But it is definitely a challenge. Well, that's me for this month. If you have any questions, please reach out to your advisor. We look forward to assisting you, and I'll see you next month. Cheers.